In the last video, series 8, we discussed the working capital cycle of a service provider, a trader, and a manufacturer. Today, in this video, series 9, let us discuss the major differences between term loan and working capital finance. We have learned that any business enterprise, whether it is a service provider, trader, or manufacturer, require investment in fixed assets to begin with. After having made the investment in fixed assets, these business enterprises need working capital finance. For acquiring fixed assets, they provide what is called as a term loan. For meeting the day-to-day expenses, they provide working capital finance. Let us understand the major differences between these two. To begin with, let us go to a term loan. A term loan is generally granted for acquiring fixed assets. I used a word called generally. There are banks who provide term loan for meeting the working capital finance also. Let us not discuss those intricacies for the present. We shall discuss those details in detail when we talk about the loan delivery system adopted by banks. So for the present, understand that term loan is generally granted for acquiring fixed assets. The repayment period of a term loan exceeds 12 months. That is, a customer, if he wants a term loan to acquire a fixed assets, normally the banks permit repayment period exceeding 12 months. It could also be possible that somebody wants to acquire a fixed assets and he is ready to pay the installments in 10 months. In such cases, such loans will be classified as a demand loan. Now, having understood the purpose for which a term loan is required, please understand that the term loan is repaid from the profit generated in the business. So we have now learned what is a term loan, what is the repayment period of a term loan, what is the purpose for which the term loans are granted, and the repayment source of a term loan. Now let us move on to the working capital finance. We know that the working capital finance is granted to meet the day-to-day expenses. When I say the day-to-day expenses, it also includes the investment that is required to be made in the stock of materials in case of a trader and a manufacturer. Normally, banks extend working capital finance for a period not exceeding 12 months. Suppose a customer has been sanctioned a working capital finance of 10 lakhs. This sanction is valid for a period of 12 months from the date of sanction. When the sanction expires, the banks will not demand the customer to repay the loan. They will look at the conduct of the account. Suppose the conduct of the account is satisfactory, banks will renew the sanction for a further period of 12 months. In case the conduct of the account is not satisfactory, bank has got the right to recall the advance. And in case of a working capital finance, the repayment is from the sales revenue. Working capital finance is sanctioned as a running account. Let us now understand what is meant by a running account. Suppose a customer has been given a sanction for a working capital finance with a limit of say 10 lakhs. The customer will not withdraw the entire 10 lakhs in one go. As and when he needs funds, either to purchase the stock of material or to pay expenses like electricity bill or the taxes or the salary, he withdraws the money. He can withdraw the money as and when required till the balance in the account touches the sanction limit. That means the customer can withdraw the funds from the account up to 10 lakhs when the sanction is 10 lakhs. However, the customer is expected to remit the sales revenue into the account on a daily basis, which means customer withdraws the money to meet the expenses. At the same time, customer repays the amount withdrawn through the sales proceeds. That is why the withdrawal and the depositing is a continuous process. In such accounts, they are called as running account. So for a working capital finance, the repayment source is the sales proceeds of the business enterprises. Now we have understood a term loan and a working capital finance. The major differences are in respect of the purpose for which the credit facility is given, the duration of the advances, and third, the repayment source. In the next video, series 10, we will go into further classification of loans and advances. When we talk about the loans and advances, generally any credit facility where the repayment is by way of installments, we refer to it as a loan. Wherever the credit facility is a running account, like a working capital finance, we normally refer it as an advance. Thank you very much. In case you have understood this, please subscribe to this channel.